All right, what's going on, everybody? What's up? Y'all have a good Friday? Ready for the weekend? Looks like we're going to get the motorcycle out today after all. It doesn't say that it's very warm out. 71. It feels a lot better than that. No wind, and that's rare for Kansas. So it's probably the last one we're going to get for the year, but I don't care. It's going to do it anyways. So, yeah, that's what I've got going on. Looks pretty good out there. Looking at the market, we rallied up well. In the morning briefing, I laid out the argument for a rally back. Let's look at the ES. It'd probably make more sense. And I drew this out earlier this week because I love this reversal, especially when it's at the bottom of a range. And it's my little loop-de-doop. Somebody said it's a fish. I guess you can get like jewelry that has that shape. I don't know, but I draw it all the time. It's the loop, right? That's what I want to see markets do at the bottom of a range, and then a gap up. I mean, that's beautiful. I love that. So that was last Friday, and this morning in the stream, I mentioned that's what we were looking for today. Is that if it went down, we want to see if it was going to run back up and give us that loop. And the midpoint is the danger spot. Well, we're not seeing the midpoint on the ES, but look at SPY and what it did. If you measure that level, look at that, huh? Yeah, you like it. It doesn't get any better than that. So now that's the level that we got to get through. If we close below it today, how we close below it is really going to matter. Are we near it? Did we ever get above it? If so, for how long, right? All of those sort of things. And then on Sunday night when we open, are we going to gap up into it, gap up above it, whatever? So yeah, that's a really nice example of the analysis working out the way we anticipate that it would. I mean, at the end of the day, we never know if price is going to do what we're looking for. Yeah, we can go over the fib stuff. Um, I know I've done it before, but I can't point right to the video. So now that I'm getting better about writing a review on the topics that we cover in the stream, we're going to do it and label it. And that way, maybe we won't have to do it again. So let's get into that because sometimes it can take a little while. Starting out with when it comes to using the fibs, there is the textbook and then there's my way. And one thing that I highly encourage people to work on is developing a way that suits them, right? Um, Somewhere along the way in my trading journey, I realized that all the stuff out there, all the different videos and PDFs and books and documents, they're not the law. They're not even rules. They are stories of somebody else's journey, and they offer some really great clues. But I found that if I tried to mimic everything that I found, it didn't work. There was always something off something wrong, something I didn't like and needed adjusted or tweaked, or there was always just something. But when I looked back collectively at that stuff, I realized that it offered a lot of guidance and insight and perspective to help me adapt things to make them the way I wanted them to be. A really good case in point was those videos that I made setting up the Think or Swim, and why I set it up the way that I did. And somebody said, "Well, how am I supposed to know all this? You already know it. That's why I'm asking you to share your charts and stuff." I said, "Well, yeah, but I didn't learn it because somebody handed it to me, right? I learned things and then I built them based off of what I learned. So it was a bit of a journey, and in the process I got something out of it." So when it comes to fibs, don't think that you have to do it any particular way, because you don't. You can do it any way that you want. Unfortunately, although that sounds really good, it leaves people feeling worse off because they don't want the freedom to do it however they want. They want to know that they're doing it, quote, the right way. And they want the validation that, yes, this is correct. It is right. That's the way you're supposed to do it. And then they don't have to worry that they're doing it wrong. In the textbooks, for an example, they will say specifically, set your chart to 1 year daily. Okay, I've got SPY, I'm on a 1 year daily. And they would say, take your fib and go to the highest point and the lowest point. We're going to um, reset my fib. This is the way it probably looks on most of your guys' platform if you haven't reset yours yet. So I went from the highest point to the lowest point, and that's what they will tell you to do. A lot of books will say if you don't do it this way, you're doing it wrong. And they'll make you feel like, yep, you're screwing up already because you're not doing it the way we told you to. This is their way, and they'll say it's the only way to do it. And if you're not doing this, you're wrong. And then, of course, you can go to the weekly. Well, gosh, that's at the same level, right? So after reading a couple of books, somebody said, "Oh no, wicks are really bad. So you should never use the wick. And if you're using the wick, you're doing it all wrong." I said, "Well, that's not what the other guy said. They're both doctors. They're both respected analysts in the field. One of them has to be wrong. How can they both be right?" So I got kind of frustrated with it. None of them talked about the intraday at all. And then the levels. Fib is especially awesome because of 618. That's the magic number. It's found in science, photography, mathematics, seashells, nature, leaves. It's in everything. It is the magic. I don't even use that damn number. It's one of the numbers that I eliminated along with 38 too. Now the 236 is just the opposite side of the 786. That way, if you draw this the other way around and 100 is at the bottom rather than being at the top, you'll still have the same numbers in there. So we don't have to get too concerned about the 236. It's just our ability to draw the thing in whatever direction we want to draw it. Some brokers, no matter how you draw it, 100 will always be on top. Some brokers are just that way. You can never have 100 at the bottom. So if you run across a book that talks about the 100 being at the top always, that author probably had a platform where he couldn't draw it the other way around. And if that's the case, and you're dealing with a bottom side breakout or a bottom side bounce, we wouldn't bounce into the 786. We would be bouncing into the 236 before going lower, right? So you have to be aware of those numbers and how, depending on your platform, yours might not be what we're posting in the chat. If I'm looking for a down day and we bounce and we pull back and I think it's going to roll over and go lower, I will say, I think we're going to get a 786. But that does not mean I think we're going all the way up here. It just means I think we're going to bounce and do what we did here and then roll over and go lower. Because I can put 100 at the bottom, right? My broker lets me do that, or my browser. What is wrong with my pen? Silly thing. Yay. So the numbers that I use, 0, 50, 786, and 100. Occasionally, I will use that 236 if I don't want to turn the drawing around. Otherwise, it has no bearing in anything that I do. And then we have anything above 100. Well, the default is 1618. It's really just 618. And then 618 again in the 200s and in the 400s. But all of that is junk. I never use any of that. So take those levels out. Now, I've never seen anybody use 1236. I'm the only one I've ever seen do that. I made it up. The reason I even started using it is because Thinkorswim had it right here, 0236. It was the inside. And I thought, well, if I wanted to get rid of these really big numbers that are way out here and I wanted to replace them with something, what would I replace them with? And I thought, well, there's a number right there, 236. Why not replace it with a 236? So that's what I did. Unfortunately, though, 236, it's quite a long ways away. And one thing that I found when it comes to price a lot of times is that if we had been in a range and we finally break out of that range and it fails, if it's like a fake break fast fail, we won't even get to the 236. We stall out somewhere early and we come back in again. So I needed something to cover the middle ground here, this area. And I thought, well, why not just cut it in half? So I added 111. And again, that's not out of anybody's textbook. I just made it up. And I love it. I've been using it ever since. The thing about making something up out of thin air is, how do you know that it's going to work or if it's even any good? So I had to go back and apply it to all sorts of stuff. I tested it on weekly candles and daily candles, hourly ranges, threw it all over the place. And everywhere I threw it, it was offering amazing insight. Fantastic. So I grew to trust it. And then it got to the point where I was using it to look forward at what could happen and where we could go next. And it's just grown with me and it's mine. So I encourage people to flex your creative spirit a little bit and try things out, because you never know what you're going to find. And as long as you can prove that it works, then who cares if you're the only one doing it or if nobody's ever seen it done before? As long as it works and you can prove it and you start to trust it, you can start making money on it. Now, I use these levels all the time, right? I should have saved that. I really should have. I just rebuilt it. So let's just get it done here real quick, get it saved. Sorry, I can't chew bubble gum and walk. Save as default. Those are the numbers that I use. And the reason we don't need 200 and 300 and 400 is because I continue to move mine higher as the day unfolds. Now, one of the questions that I get is, well, what can I measure with it? What are the rules? Well, it's not like that book that talks about going from the absolute high to the absolute low and only on a daily. You can literally measure anything. For an example, markets are fractal in nature. I know that that sounds very complex and complicated, but let's uncomplicate it. This one bar on a daily is just that. It's just one bar. But if I open that up on a 15-minute chart, how many 15-minute bars go into a 1 day market candle? A lot. But what if I go to a 5 minute? Well, now I have even more. So I know that inside of this one daily bar, I've got a lot of bars. They can make ranges and patterns, cup and handles and flags, and all kinds of stuff can be inside that one bar if I was just to go to a different range. So I can mark just that one bar if I want to, just like that. And looky there, there's that half back, right? So on this time frame, sure, it might not make too much sense. But if I was to go inside and look at it now, because price is fractal, we have fibs on yesterday's price, and we can see how the market responded to those fibs today. So we can literally measure anything. Now, over the years, I did build a set of rules for myself because while we can do whatever, I found that if I had some structure behind it and some things that I should and shouldn't do, then it worked better. So, one of the things that I like to do with this is to focus on specific ranges, like only the Globex. That would be one thing all by itself. And only the RTH of the previous day. That would be a separate thing that I could measure. And then all of yesterday. That could be another thing that I could measure. And the reason we want to break it down that way is because of what it offers. If I move these drawings, my half will change places. And if we break out, how far the indicator extends on the breakout will change. So obviously we got to get through the smallest range first, and we have to get through the most immediate range first. Take today for an example. I don't need to worry about yesterday's price until we can get the heck out of our Globex price. And this was our Globex range, right? Let's dial that top in here a little bit. All right, that's our Globex top. That's the Globex bottom. Until we get out of this box, I don't really care what yesterday did, right? Especially as say we come into the 9:30 open. It won't have any bearing on me to what happened yesterday until we resolve this. Even the low of yesterday wouldn't really have any value in the RTH because we had already crossed through that level multiple times in the Globex. So my only focus is, can we get outside of this Globex box? Now, while we're in the box, we can certainly put the fibs on, and they have something to offer because this is the most immediate range and it's what we have to deal with. We can see that when we got our breakout, we got to the 111 and that's where we stalled. So we fell back a little bit. I call that a first touch play. On the ES or MES, SPY, SPX, whatever, depending on your product, you can get a couple points on that pullback a lot of times. And for me in the ES, a 5 point pullback is a really awesome trade because I'm not trying to get 20 points and 60 points and 100 points. I just want five, maybe seven. And if you do that with 10 or 20 contracts, you're good. Just call it quits, come back tomorrow, get another trade. So a first touch play is a fun trade, profitable. You find a lot of them. And those first touch plays, sometimes they're the only touch, and we just fall right back down again. We didn't this time. We touched it, we pulled back a little bit, then we ran back up and we tried to break it again. You never know, but it's called first touch for a reason. If it's the first time you've reached that level today, it's very likely to react. That's not just for this pivot or for this drawing in general. Like first time you touch VWAP, the first time you touch the moving average today, the first time you touch yesterday's low, first touch is a pretty common concept. So you want to get used to the idea that the first time you touch a level, you could get a first touch rejection off of it. Well, whatever comes first, Austin. If I'm inside of the Globex right now, then I don't give a damn about yesterday's range. I only give a damn about Globex range because until I get out of it, yesterday's range has no impact on me whatsoever. We always want to ask the question, what's the most important one? What do I need first? It's kind of like, do I need tires for my car? Well, yeah, you need tires for your car. Well, I don't have a motor. Well, okay, well, if you don't have a motor, you really don't need those tires, right? So, do we want yesterday's range? Oh, absolutely, yes. But what's more important? We got to get out of the range that we're in first. So, if we happen to be in the Globex range, then that has to be resolved first. Of course, you can also just ask the question, what does yesterday's range have to offer me, and where will I come into contact with those ranges? If the answer is I'll come into contact with those ranges after I'm already out of the Globex, well, then deal with the Globex first. Remember, this isn't about trying to run on some checklist, right? Because that won't do. We want to use these levels to evaluate and anticipate market behavior. So, in that anticipation comment, one of the things that I always try to stress to people is if you don't trust it, you won't trade it. You'll screw it up, you'll break it, you'll get out too soon, hold on too long. You won't even take it at all. You'll just be too scared to put money at risk because there's no trust. But trust in what? Trust in the strategy, trust in the system, trust in you to be able to do it correctly. All of it. Well, how do you get trust? If I can't explain it good enough for you, then you won't trust it. If you don't understand it well enough, you won't trust it. Trust will come if you put in this kind of work. This is the best work approach that I've found. I haven't found anything that does better than this. And what this is grabbing examples of a particular trade that I want to trade. But this is also analysis. I'm using my fibs and I'm marking out only the RTH in this picture. Only the RTH. It's yesterday's high and yesterday's low. And we're looking at what happened when price broke yesterday's low. We got to the 111, rejected, and we came back in. A very nice first touch play, by the way. Now, it's not always going to do that, but a phrase that I use oftentimes is if a breakout is going to fail, it will likely fail at 111. And that's true. Sometimes we'll fail at the 1236. Yes, but we fail at 111 way more than we fail at 1236. So if a breakout is fake, it will very likely fail at 111. And that's good to know, right? That's the premise of the whole play. But what if it's not fake? What if it's a real breakout and we break out and it runs through 111? then it's going to go to the 1, 2, 3, 6. And then we still have to wait and see if it's going to be a reversal or not. So on this one day, which I dated so that I can go from the picture to that day if I want to, I keep this in my file so that I remember on February 27th, we had an inside day breakout with a 111 rejection, and we came back in and ran all the way back to half. Anything that I learn in the future that will help me trade this better, I will be able to go back to that particular day and get new pictures with whatever I've learned that made a change. And I can add that to this and have new pictures so that as I grow as a person, so does my strategy. This was the very next day, the 28th. Yesterday's high all the way up, not just the RTH, but the whole darn thing. And yesterday's low, 111 rejection, rejection, rejection. Now that one overshot, but it's a tweezer bottom reversal. So a really nice reversal bar, reversal pattern, even though we didn't necessarily stop where we should have. And yet again, it's just another example of how these fibs come into play. When breakouts fail, they often fail at 111. I know that to be true. I see it over and over all the time. And this is just another example of it. It's also another example that the 786 is often the structure that creates the channel. I can't draw on that drawing. My drawing tool will just act really goofy. So let's just come over here and draw that fib. And there's the 786. In fact, we'll just do this. So if price comes down and it tries to break lower and fails, and it's still sitting in that range, that 786 oftentimes is where the top of the channel is. You'll see that a lot. So that if we are going to reverse and go back up again, it has to get through that 786. And so if the recovery is going to fail, it very likely will fail at 786. So now the system works both ways. We can monitor the downside, or the breakout point, the 111, because this works going up, not just down. We can monitor potential breakouts, and if that breakout is a failure, we can anticipate reversals at 111. And if we try to go back the other direction, if 786 fails, then we're likely going to run back again, and then we'll create this channel. But if we can get through the 786, we can form a cup or an inverse cup if this was upside down. Here's another example. Yesterday's high, yesterday's low, 111 on the top, or excuse me, 111 on the top, and again, and then a 1, 2, 3, 6, all the way across to the other side, 1, 2, 3, 6. Now I didn't put it in the picture, but if we was to mark out the 786, it would have been right in here, right around that 59.50, maybe 59.45, somewhere in there. And it held the first time, but it did not hold the second time. Still, it was developing the channel right in here. It was trying to hold it, and then down we went. It does. So this strategy so far, everything I've been showing you was really big picture looking at yesterday's 111. Well, here's yesterday's 111, just the line. And we can see the 2-bar reversal there. It's not a really good 2-bar reversal, but it's a common one. This is a better one down here, more of the railroad or the tweezer bottom. Now this is November 4, and it zoomed in. I'm going to jump forward because that's also November 4, and so is this one. This is the big picture of that move that we were just looking at. So I had the zoomed in versions, and now we got this one where we're zoomed out and seeing the whole thing. And you can see yesterday's low and the 111 textbook tweezer bottom 2-bar reversal off of that low. Now, all of these are just analysis concepts and my yesterday's 111, but they are static. They stay put and we don't move it. And one of the things that we want to talk about today is actually moving a fib in a live market to track a trending market and identify the next potential pullback, the next pause point, and the next level higher if it continues to move in the same direction. Right. So, all of those just really good examples of my 111. But keep in mind that the candle I was measuring, it could have been any candle. It could have been a 1 hour bar, a 15-minute bar. It could be the 5-minute bar, the very first 5-minute open bar. Now, on these days that we get where we break out and we run and we've got trend and we're just going and going and going, we can dynamically update the fib as it goes. Now, we can use any chart time frame, but I do my work on a 5-minute. So I tend to work my drawings on a 5-minute. If you like the 2 and you're hanging out on the 2 all the time, then get familiar with doing it on a 2, right? Use whatever you think works best for you because remember, it's not about doing it right, doing it wrong, trying to mimic what somebody else does. Learn from what I'm showing you and then adapt it in ways that suits you best. So what I measured here is the intraday range before the breakout. We had the morning session. It was a bunch of chop. We were hanging out along the lows. We got back up and we were getting ready to break out into the afternoon session. And that is a very valid range to measure. I've got the low of the day and the high of the day. I don't need to worry about yesterday right now because this is the most immediate thing that we have to break out before I can get anything else done, right? Say it's noon and it looks like that. I don't care about yesterday. So there we get the breakout and it runs up, and that right there is OCC, opposite candle color. I've had people say, why don't you just say it's going to pull back? Well, because that's not true. And it's not even what I'm looking for. I'm looking for an opposite color candle or a doji. That's actually the full sentence. I don't say the full sentence often enough, but it needs to be opposite candle color or doji. And it needs to close. A lot of the things that I do, I don't wait for candle to close. Why would I? But for this one, I have to, because if it's not closed, how do I know it's actually the opposite candle color? At any moment, it could run up and break the open, and then it wouldn't be opposite candle color. So it has to close. So we wait for it to close, and now I update my drawing. Now, what I'm about to say next, there's two scenarios that you can do this. Neither one are wrong. One is a little more complicated, but it doesn't make it better or anything like that. I put the drawing on the body on the side that we're going. So if we were going down, I would have used the body on the downside, but we're not going down, we're going up. So I use the body on the upside. It's the last green bar body because we're going up, right? If you don't want to do that, if that is complicated and you're like, no, it just seems like too much extra, You don't have to do that at all. You can just go to the highest point. So we got the highest point and the lowest point. And if you're thinking, well, I want to do it the way you do, Sig, well, I end up having to use both. Here's why. The midpoint is only a real valid mid if you go to the very top. If you go to the body, that mid is not real. It's not valid. It's not a good mid. It's only good, it's only valid if you're at the very top. So when I'm drawing my drawings, I go to the top to see what the mid is because I want to know where that mid is in case we do actually start to go down. But then I move it back and I put it where I want it, and that's at the body close. So you do you. I promise it doesn't matter. You can do it either way. But what we want is the highest point to the lowest point, and we want to project that 111 and the 1236 to the upside. And we leave it there until the next opposite candle color. Now, if you notice, we overshot that 1236 and it kept right on going. It's not our fault. We didn't do anything wrong. And it doesn't mean that the system doesn't work. It was supposed to stop here and pull back. There was supposed to be profit taking and then others eager and happy to take their place. And then we run up and we keep going. Instead, it was so aggressive and the buying was so strong, it overshot our stopping point and it went an additional stopping point higher. It's not perfect, but it's pretty close. This is the range between each point, and that's where it stopped. Was one more up. So not perfect, but it continued on. And that's a warning to us. Wow, it's so strong. It didn't even stop for profit taking. So I don't get mad when it overshoots my drawing because that just tells me how strong things are. If it hadn't even gotten there at all, that would be a warning too. So we finally get opposite candle color, finally. And when we do, and that candle closes, we can move the drawing up again. Each time that we move this drawing up, we get a new 786, a new 111, and a new 1236. Look what happened to price when it got to the next 1236. It didn't overshoot at that time. It shut that thing down. And they tested it again and 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 again. They didn't make it. They were done. And on the downside, we kept coming right back into that 111 or the 100, and we just wasn't able to get through it. Now, because we did get to the 1236 and we rejected, we could move our drawing up on that one right there. We could. What I end up doing is if I move it up like this and we stay stalled out, it makes me start believing that we're actually going to go back to this half. And I go ahead and I move it up and I take the high a day or low a day, right? Because at this point, I'm getting more and more confident that this is going to fail. And I want to know exactly where that real mid is. And then I leave it there. I don't pull it back to the body. I leave it there. And if we get anything newer or higher, then I go ahead and I do that because we're not trending anymore. We're not broke out anymore. We're not expanding anymore. And moving the fib in a dynamic, measured level higher does no longer make sense for the day. And I'm done. So that's how I run my dynamic fib placement. I use only the intraday when I'm running these dynamic fibs. So if I am marking yesterday's levels, once we've exceeded the 1236 of the previous day, I'm done with that drawing. I'm done with that day. It has nothing more to offer me. I move my drawings over into today's market, not yesterday's anymore. Now, you'll find that when markets are aggressive or if we get one time framing, really violent price action, that it's going to run right through your fibs. And that does not mean you did something wrong. It doesn't mean the system doesn't work or that it's broken. It's just telling you that it's so aggressive, they didn't even stop to take profit. They just hammered it. So you have to be patient and wait until you finally get that OCC and then you set it up. There's the 786 pullback. There's the drop down into the new 1236. Once we get OCC, we're valid. We can move the drawing. There's our new update. A new test into a 786. And then down we went. Even when we got to the 111 here, they tried to reject it, but we couldn't get back up again. And we waterfalled back down, overshot again, highlighting how aggressively negative things were. Finally got the OCC. We update it. Couldn't get above 786. Couldn't get through 111 down here again and again. Couldn't get through 786 across the top. Those levels are so awesome. I use this thing constantly. So, some rules when it comes to using this that I apply to myself, you do you, is when I'm trying to use them in the RTH today, I don't like to do anything less than the first 30 minutes. That's a rule of mine. Now, don't get me wrong, I will sometimes measure that first 5 minute bar if it's like a really big 5 minute bar. We've seen those. This is certainly not one of them, right? But we can get this one first 5 minute bar. It's a big, massive bar. There's times where I'll measure that, but most of the time, I don't want a fib until we have at least 30 minutes of data on today's RTH. That's one of my personal rules. All rules are meant to be broken, so, I do break it once in a while, but it doesn't it doesn't work good, I have found, if we get, you know, 15 minutes into the day and I try to snap a fib and look for halfbacks and 111s and 1236s in this little itty bitty range. I found that I it just doesn't work very well. But if you give it at least 30 minutes, if that is still your range in 30 minutes, then fine. That's it. That's what you have to work with. But so that's one of my rules. Another one is that I accept the analysis, right? I don't get to decide to move the lines until it suits my needs, right? Like, should you use the wick? Should you use the body? And you're not sure, so you move it and it tells you that the trade that you've been wanting to take, you can finally take now because the line measured right. I don't do that. So if I put it where it's supposed to go and it doesn't line up, fine, it doesn't line up. I'm not going to cheat the system to get it to line up. I'll try to understand why it didn't line up. Did we come up short and just not reach a level? Did we overshoot that level because we were too strong and too aggressive? Another thing is that these lines and these levels are not a trade trigger. Just because we get there doesn't mean that I have a trade, long or short. That when I put these lines on, they are just like I explained, places where I expect to see price respond. If it's a 786, then I expect to see price stall there, maybe have a hard time getting underneath it. And that if we do get through it, we're likely going to go to the half. That if we get through 100 and we are experiencing a breakout, that it's likely going to fail at the 111 or the 1236. I try to get a bias for the trade before we ever get to yesterday's high or yesterday's low. Now, that's a key piece that is often overlooked. Yeah, I have people say, well, how am I supposed to know if I should go long or I should go short when it gets to that level? Right. And that's a fair question. We get to yesterday's high, we're just about ready to break out. Should we go long on the breakout or should we short the breakout? And price will lie to you. I promise price will lie to you. I'm a price action trader, and I'm still going to tell you it can look the most bullish of any price you've ever seen in your life, and you'll swear it's going to be the best breakout ever. And then it'll just turn around and come right back in again. Why? Because price lies. We do the best we can with the information that we have. Yeah, senators. Well said. So with this or with anything else, if you're thinking about using these, the more experience you can get using them, the better. If you can go into the past and apply them somewhere and test them, validate them, prove them right, prove them wrong, it will help. So here's an example. I marked out the high and the low. Looks like I didn't get that low exactly right. Let me move that just a wee bit. And I'm just using the box to highlight the area that I'm marking out, right? That it's the RTH of this day. And the next day, we can see the breakout. Okay. So I'm going to extend the box so that we can zoom in. Now, when we were still in the middle of the day, let's run the replay here. When we were here, I promise you, I'm thinking about a 111. This is the way that I do business. I'm not looking at this thinking, oh boy, what a beautiful opportunity. Man, if we break out of this clustered turd, I got to trade. I'm not thinking about it at all. What I'm thinking about is, oh man, my favorite trade ever. I love this trade, and I really do. I would get a t shirt made of this thing. 111, baby. I love it. Oh, I wish we would break out of yesterday's range so I can get a 111. That's what I'm thinking about, even when we're right here. Because I'm constantly asking the question, where would I like to have a trade? Well, I'd like one at the low of today if we was to go there. And if that fails, I would like to get one here or maybe even one right there. If we go down, those are three areas that I'm probably going to focus on for a trade. When I'm looking at the upside here on this particular day, I'm not really excited about an upside breakout. Why? Well, because it's the midpoint of yesterday and we're struggling with it. We've got all these wicks across the top and it's really sloppy, really nasty. I would not be interested in a breakout up here, but I would be interested in breaking out of yesterday's high. And so that's what my focus would be because I want to have a clear path forward long before we get there. I look at bonds, dollar, treasury, tick, UVol, DVol. I look all over the place. I don't have time to do all that if I wait for price to come all the way up here and then break out and then get to the 111 and start to reverse and then me say, "Oh, wait, time out. I got to go look at all this stuff and see if everything looks good and try to figure out, is this breakout supposed to go higher or is this breakout supposed to fail and come back in again?" I don't use this enough, obviously. We'll just run it forward. It'll get there. So when you're thinking about your trading day, try to anticipate where you want your trade. And a phrase that I use is, I don't want to trade where we are right now. I know that sounds like a very odd thing to say because eventually we always trade where we are right now, eventually, right? But what that means is just what I was explaining. I don't want to look at price and say, "Oh, yeah, that looks great. I'm going to go get a trade." Uh-uh. I plan considering where I want to get one. If it never gets there, if it doesn't let me in, if it never stops and just keeps going, well, those are issues I have to deal with. But I know where I want to get a trade. All right, so we got there. The candle closed. We got a new candle that opened, and now that one closed. We've got an OCC, but it's on a 111. We wouldn't be updating the drawing or anything like that. I can already tell you that if I snapped fibs on the RTH of this particular day, it looked like we overshot them, right? It looked like we went too far. But we can snap them, right? Because we can have multiple fibs on at the same time. This would have been the last fib placement right there. I'm gonna stretch it just so we could put the lines on because I noticed they're missing. Now I'll put it back in place. Wow, it's really noisy, isn't it? Let's turn the extension off for a moment. They're still drawn. They're just way back here for a moment. If you look at the intraday, we broke above the 111 and we almost got to the 1236, but we didn't get there and we're starting to stall out. Let's get another candle. That's a evening star reversal. It's not a good one because we didn't gap, and maybe we could just call it a 3-bar reversal or a rally base drop. But whatever we call it, that's a reversal pattern. And we know it's yesterday's 111. We also know that this is a 6850 overshoot. So we broke out of 6850. We rejected off of yesterday's 111. We failed to get into the 1236, which is also another sign of weakness. And then we got a 3-bar reversal pattern. This is a shortable opportunity. Now, we could trade the reversal. The trade, if you was looking to trade it as it was actually unfolding, one of the signals that I like to use is the midpoint of the last bar, right? I like that one. So as we break that mid, that's a way in. Breaking the close of the previous bar, that's a trade. Not in this one because it would have been too tight, but right, that's another one that can be used. And breaking the low of the previous bar, that's one that can be used. But all three of those are an aggressive entry on something that we still don't know enough about yet. Why do I say that? Because we're still inside of the last bull bar. So if we're still inside of the last bull bar, any short right now is aggressive. But that doesn't mean wrong, right? And I'm as aggressive as anybody else. I've done it and I'll do it again. It's just worth mentioning. So when do we swap over from yesterday's to today's? when it's no longer relevant or valid. Remember what I'm using from yesterday. There's only really three lines that I want: the yesterday's mid and the yesterday's high or low, then the 111. So if we're going up, the three lines is the mid, the 100, and the 111. If we're going down, it's the mid, the 0, and the 111. Three lines. At any point during the day, I'm going to use what we have within our trading day until I have to deal with the mid, the high, and the 111 of yesterday, or the mid, the low, and the 111 of yesterday. Until we are there, I want to use what we have here. Right. Absolutely. And we don't move it, right? So if this breakout had actually broke out and started to run, we would never chase it with our dynamic fibs higher. I don't do that. But as I said at the beginning, feel free to try things out. I've got coaching clients who have started doing something that I don't do. And yet, I got to admit, they've proven that it works and it's a really awesome thing. I just haven't found a way to put it into my own style yet. And what they like to do is they'll use the RTH high or the RTH low of yesterday and our own Globex high or low. So in this scenario, they'd be running that. I do not do that, but I got to admit, they've they've shown me again and again how it works. You use it the same way that we would do, the 111 down here and the 1236, or the 111 and the 1236 up here. And yet it's not mine, right? And more than one client does this. They each got there on their own, unless they're talking to each other and I don't know about it, which, I mean, that's absolutely possible. But still, the point is, these are adaptable, and there's no rules as long as you can prove that it works. I do think that calling it quadrant lines is more valid than calling it fibs. And the reason why is because fibs have the magic number, right? The 618. This does not have the 618 in it at all. And if you look at the way most brokers offer fibs, they have your fib retracement, and then you have the fib extension. And they're very specific about, well, this one's for this and that one's for that, and whatever. I don't use any of that trash. All right, just wad it all up and I throw it in the garbage. So maybe calling it a fib isn't fair because we're not actually using any fib lines. But the reason I never correct anybody if they do call it a fib is because it really doesn't matter if we call it a fib, right? We can call it late to dinner. It doesn't matter as long as we understand what it's trying to offer us. So fibs, quadrants, for people that go to use it, some of the biggest struggles is, what should I measure? Is this valid? Is that valid? Is it okay that I start here and I stop there? I get that question all the time. And the best answer is prove it wrong. Using yesterday's high and yesterday's low, prove that that isn't successful or that that wouldn't work. You know, you can't, but you could at least try, right? So we can measure anything, we can test anything. And the more examples that you can find, that you can build for yourself to prove that it works and to prove that you trust yourself to draw it correctly, the better you will use it. if you don't doubt your ability, if you doubt your ability to draw it correctly, then you won't use it correctly. You'll have doubts, get out the wrong time, you won't get in at all, you'll be late to get in it. All kinds of things will go wrong because you don't have any trust in it. But nobody can give you that trust. So that's my fibs. I absolutely love them, and I'm sure at some point I'm going to write a book and throw the whole industry right on its head so that they can hate me since I'm going to be like the Beetlejuice of the fib market and just pooping everybody's Cheerios. Yep. Because I mean, I don't know how many fib books you guys have read, but they suck. They just really suck. And if anybody has a really good fib book that does not suck, I would love to read it. But most of them that I've come across don't even touch on intraday at all. And if they do, they skim the lines using 2 hours or 4 hours. They might as well be on a daily. And they are very strict about what you draw and where you draw. And here's the thing, we're not done. Let's catch a couple things. Anything can be measured. Even say like yesterday or today, if the levels get too far, too long, and you're stretching that drawing out too much, you can shorten the drawing. Like this, that that next 111 and that next 1236 is a long ways away. And if you're looking at that and you're thinking, wow, man, that's just so much, you can just shorten the whole thing up, bring it into the next level. Why not? Because we can measure what, yeah, yep, yep. You can tighten this thing up to where you're just using the most immediate range if that's what you want to do. That's what we just did. Whew, better him than me. Yeah. That's why Marziti mentioned this level right here. From the 7th to the 12th, we're only measuring this rollover. And it's valid. It's perfectly valid to do that. Of course, we can also reach back and do that. Yeah, that one's been on my radar. Yep. The levels being so far away that you can't trade them brings us to another thing that offers levels, and that's spot gamma. So every day I share those spot gamma levels. And to me, the ones that have the most value are the call wall and the put wall. Sure, I want to know if we're above or below zero gamma, but that zero gamma level isn't normally what I want to trade. I just want to know if we're above or below. But the call wall and the put wall, they're usually really far away. You're not going to get an interaction with those a lot of times. Well, if you went to Spot Gamma's website and you started poking around into the levels that they offer, they will tell you that, hey, if you're intraday trading, you shouldn't focus on the call wall and the put wall because they're too far away. What they will tell you to do is to focus on these other levels. These are the levels that I'm talking about, by the way, right here, that I post this picture every day. Well, those levels, the combo and the large gamma 1 and large gamma 2, they are in this text document right here. It's the spot gamma thinkorswim levels for today, November 14th. You can download that document and copy and paste the code into an indicator, and it'll put all of those lines on your chart. And if you was to read Spot Gamma's report, they say that you're most likely to interact with the large gamma 1, large gamma 2, rather than the call wall and the put wall. And so, as a day trader, those would be the ones that probably have the most value because they're the ones you're most likely to hit. I mean, you definitely want to know where it is, right? Because if we exceed it by an exceptional amount, they will hammer it. But I've seen price walk right through it like it isn't even there, and just overshoot it, go beyond it. But as long as we're not exceeding it in an exaggerated way, I don't anticipate much of a response there. I'd love to see some detailed examples where price did respond to it repeatedly. It's kind of like that homework I was telling everybody about, that if we can go back and put those levels on and look in the past at what price did there again and again and again and again, and we can prove that it has value, I would pay attention to it a lot more. Thinkorswim has a strategy built into it, and by using strategy, we can build a code as long as the the lines are there, where it will trade every time price got there. Now, we don't care what the outcome of the trade is. Instead, we would be wanting to know, A, how many occurrences did we have? Like how often did we actually get to the lines? And then B, were those reversals or were they continuations more often than not? And so the P&L of the strategy would tell us that. It would show us occurrences, and then it would show if we traded breakouts and they failed 70% of the time, then that would be great. That would give us some really good answers to how often it fails the breakout. And that way we don't have to manually do the work, right? Going back and scrolling in the past and doing it all by hand. The Mentor Q 0-day levels are pretty awesome. But when you bring in something like Ballland, who also deals with 0-day flow, but their perspective is how much dealer exposure is left, and are we going to see dealers make a radical change to their positioning? I'm looking for it's probably right under my nose, but I'm not. Dun, 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 probably the wrong screen. That's why. Ballland. Right now, I'm looking at the total 0-day options volume, and we're running at around 2.6 million on the SPX, and we are in a sigil extreme paradigm with a line in the sand at 67.45 and 67.66. Now, they have some weird language, one of them being, quote, paradigm. That's that's totally Volland right there, because their argument is we're not always in this Gex paradigm where dealers have to respond to positive and negative gamma. And they're right. Sometimes we're in a different paradigm. So they've got some white papers, research papers that prove sometimes we have these quote other paradigms, and they got different name for them. The paradigm just shifted while I was talking, and now it's an AGLIS. The LIS still means line in the sand, but the paradigm changed to an AG. And off the top of my head, I can't remember what the AG is, but they have a Bank of America one. They have the regular Gex one. These guys, when you mention spot gamma to these guys, they spit, just straight up spit, and they say spot gamma is trash. What a waste of money, time, and effort. And they said I would never put $1 of a trade on in risk if I was using spot gamma's data. Now, that's some bold statements. They back it up. But their system is completely different than any other system that I've ever come across. And it took me a long time to even begin to understand what the hell it is they're even doing, let alone how I can use it. Thankfully, they take feedback because their tools are not retail friendly, not even a little bit friendly. So they've been slowly adapting the system to make it more retail accessible. Plus, the subscription that I have is $1,500 a month. A lot of people aren't going to want to pay $1,500 a month. I don't pay $1,500 a month, but that's what it would be if I was paying for it. And you got to be pretty bold about your data to say something like spot gamma is trash and it's a waste of money. You know what I mean? Like that's a pretty big statement. So the good thing about these guys is they know that they're complicated. They built an academy to teach people what their product does and all of the different things that it can do. And they have different payment tier levels. They're not all the most high end one that I'm using. Um, I think the lower levels, the app just doesn't update as fast, right? That they're slower to update, maybe every 30 minutes instead of every 30 seconds or whatever it's doing. No, this info is not in the bots below. This is from a company called Volland, VOLLAND. Those bots that you're asking about are from TradeyTick. And TradeyTick is a pretty awesome website, I got to say. A great tool. It's retail friendly, right? It's going to look at calls and puts traded by the masses and really focus on just your simple, basic levels. Let me get logged into this one. It'll map out unusual options activity and things like Apple, Google, whatever, SPY, the Qs, and it does do dealer positioning like the level here with Google. We can see the dealer positioning. If the dealer is negative, then retail is positive. And so dealers are still negative. Retail is still positive. Even in this pullback in Google, they are still positive. I can ask it for whale targets, which is basically just big options levels. But I can also get support and resistance levels. I can get dealer levels, right? We can just come in here and choose GEX, whales, zero DTE GEX, largest sweeps. I can even do block trades and dark pools. All that's pretty cool, right? Pretty handy. And that's what's built into the Discord so that you can call up, and get uh, intraday gamma flow and options flow right in the Discord. I'll add to that. Um, One thing about the 786 that I really like, let's start with what the textbooks say about Fibonacci. I'm going to put mine up here for a moment so that I can copy it again later on and I don't have to rebuild it. So let me reset Fib. The textbooks talk about 618 as the level of pullback where they want to see a healthy digestion that traders got out, closed trades, and that other traders came in and were happy to take their place. Right? That's really the way that they describe it in the textbooks. So let's go somewhere so I don't lose that fib line that I just drew. So according to the Fibonacci textbooks, if we drew it from the highest point on the daily to the lowest point on the daily, there would be a 786 level. I don't know why that didn't. Oh, because I didn't reset to factory. Let's draw it again. The textbooks would say as long as it doesn't break under 618, then that trend is still valid and we could continue to go to the upside. So this is what the textbooks are saying. Well, look at how far that 618 is. It's a long ways away. And if you look at the old fib books that are out there, think about when they were written. 2005, 2007. Hey, Marziti, have a good weekend, buddy. Always glad that you stopped by. I'm hoping to get the bike out myself. I hope you do something fun this weekend. Well, you'll enjoy it when it's done. Yeah, that doesn't sound like much fun at all. You're not doing a spray in? Yeah. You can rent a scaffold jack for like $18 a day. Yeah, and they look good. Yep. Hey, they got that popcorn ceiling texture in a can. Well, not me. I don't like it. Well, you have a good weekend. All right, so the textbooks would say as long as price didn't break and get underneath that 618, that the trend is still valid. But those textbooks were old, 2005, 2010. And if you think about the internet they had back then, they were all running delayed data, and paying thousands of dollars to get that delayed data. And they needed time for people to know what other people was doing to even be able to validate that they were at a 618. That doesn't fit our modern world. So the more I looked at my fib process, I decided screw that 618. I don't want price to be so weak that it actually goes to a 618. So for me, I was like, you know what? As far as I'm concerned, if it gets below the 786, that trend is in danger and it's weak because I should have already seen happy and aggressive traders coming in to take the place of those that were getting out long before we got to a 618. So if you've got price that is trending and we're measuring something that's moving, it needs to pull back, right? Because profit taking is healthy. It's a part of the move in trades. So we want the pullback. And that can overshoot 786 because it's an imaginary line. It's not, a God level. So we can overshoot it, but we don't want to see extreme moves underneath 786. We want to get to it, near it, around it. And if we don't even get back to it, if we just start to fall a little bit and tease it and never actually get there, that's fine with me too. What I don't want though is to get down into that level and hang out there. Because again, where's my aggressive buyers? Or, if we flipped it over and we were going down, where's my aggressive sellers? If we get there and we pull back and it hangs out along the low, well, screw that. I don't see the aggressive buyers or sellers anymore, and it calls into question my trend. So that 786, you're right. It is a sneaky little booger, and it can steer you the wrong way 100 ways to Sunday. But I love having that 786 on there for the most part for reversals that fail, right? So let's put one on for today with this 786. Suppose we were earlier at this level right here, and we had, where's my, I had a good drawing here. I know I did. There it is. Woo. I didn't want to have to rebuild it again. Save as default. Get rid of this trash and get rid of that. All right. So say we were here at this particular time and we break up into the 1, 2, 3, 6. So we move the drawing, and now that's my new level, and we fall back now into a 786. At this point, where's my aggressive dominant buyers? They're not there. It killed my trend right there. And we failed to get back and get an equal high, get new highs. The trend is dead right there. Now, trends that die can be revived. So this could die and stall for like 2 hours and then run back up and break out and keep going. It was revived, but it's dead. We're not in a downtrend because we're not dropping down into like the half and we're not going lower, but the uptrend is dead. And I really like that. Yesterday we had a fake out the other way, right? It was I think it was here. Maybe it was here. One of these, and it's where you get down into like a 111 and it looks like we're gonna stall and go back up. And then we hit the 786 and we fall back down again. So it's like it started to fail, got to 111, ran up to 786, that failed, and then we came back down again anyways, and we ended up getting into the 1, 2, 3, 6 after all. So I like that 786 for a lot of reasons. I think it was somewhere in here, right? Seems like it was. I could be on the wrong day for all we know. Yeah, I think it was here. We got into 111 and we failed to get to the 1236. So it ran up and yet it failed at the 786 and we came back down again. So I really like that 786 for what it represents. I want to see those dominant buyers or dominant sellers, if we're going down. I want to see them stand up and jump into the market on those pullbacks because those pullbacks are our opportunity to get long or short in a market that's running. Because I don't know about you guys, but I don't like to buy markets when they're running up. And I don't like to sell them when they're running down. I want some kind of pullback, right? So, a key takeaway is to keep in mind that no level, whether it's yesterday's high, low, Globex high, 111, doesn't matter what it is, no level is the trade trigger. It's just a key area that we want to watch for because that's where we anticipate price doing something, rejecting, consolidating, OCC, something. And if we have a bias that tells us what to expect at that level, even better, even better. It is no guarantee that we're actually going to have a bias, but if we have one, that's even better. Nvidia's got earnings on the 19th. We're going to look at December 19 options. Um, this is not for me. This is somebody asked me for this. They want a call credit spread. We're going to build it at the money, $1 wide. If the trade crashes and burns and is absolutely no good, they're going to lose 50 cents. That's $50. And so, what do we got? The sell 191, buy 190, December 19. All right, got it. Or at least I thought I got it. Okay. I was checking out a different prop firm in November. Is these guys. They've got a really sophisticated platform. I'm not going to end up keeping with these guys, but not because they did anything wrong. It's just I've spent years using Trade and TradingView, and it's what I want to use. So I'm not going to keep them. But we were talking about customer service the other day, and I've never seen a customer service in any industry. I'm talking, warehousing, dentistry, doctors, car salesmen. No, I've never seen customer service like these guys. It's absolutely amazing. I don't like this platform only because it's not my platform, but it's a really cool platform. It's got all kinds of neat stuff in here too. But I'm not going to keep them. Um, if I was new and I had not yet gotten accustomed to all of the tools that I normally use, I would totally use these guys. Funded Futures Network, FFN, and this platform is called the Fund X Broker. Um, Hands down, their customer service was the most responsive, polite, useful. I submitted a ticket, and in 30 seconds, somebody was there asking how they could help. And I was like, that's not normal. That is normal. That they are known for it. They're famous for it. And every company always says that, oh, our customer service is number one, blah, blah, blah. And usually the more they brag about it, the more it's not. It sucks. But I gotta say, these guys were really awesome. It's too bad I'm not gonna stay there. One of the things I liked is if you notice, it's probably hard to see in the zoom. When I stop my mouse on one of these candles, it turns hollow because I can click on it and I've got all of these things that I could do to, for an example, see the time and sales for just that one candle. I could do it. And while I have that time and sales up, I could sort it by block trades, sweeps, delta. It's absolutely amazing. I mean, it's a really cool. Tradeovate, on the other hand, let me log out of this. Tradeovate does not look like this at all. Most people hate how Tradeovate functions, hates how it looks, and they end up trading on TradingView with their Tradeovate account. I do both. Um, Most of the time, though, I got to say I just trade on TradingView with my Tradeovate account, but I do both. We'll just log into paper so I don't screw anything up. This is Tradeovate. Gotta let it finish loading. Now, when way back in the day, Tradeovate and Jigsaw were partnered together, and it was kind of slick on Tradeovate's part because they wanted to know how order flow tools functioned. So they partnered with Jigsaw, and then they hijacked a lot of those tools and built it into the platform so that you didn't need Jigsaw. That's sneaky stuff. Now they're not partnered together anymore. I mean, you can still trade Tradeovate with your Jigsaw broker, but um, they used to like complement each other and connect on social media and all that stuff. And I never see that now. But so Tradeovate has built-in order flow tools that are kind of pretty cool. So like time and sales is color coded. It doesn't seem like very much, but there's a lot of information coming through in the color code that you see. I'll just grab a picture so that we can discuss this code. When we change price, when we tick down, it changes color and it gets dark red in the background. So you can see we went from 68 and a tick to 68 flat, and then we ticked down again. And because we were changing ticks, the dark background, the red background, I mean, is solid. But then we stayed at 75. And so all these orders were coming in, 9 here, 7 there, 4 here, but we weren't ticking down. We were just getting all these sell orders and we were staying still. Well, that's kind of a tell, isn't it? If we drop down and we drop down and we drop down into 67, 67, 75, and 34 sell orders come in, but we're still not going down after 34 sell orders. And then we start to move back up. So when we ticked up, the background turned dark green. Then we stayed there for another 4 and we ticked up again. It turned dark green and we stayed there again for another 5. When we got all the way up here, see how we just stayed there. We had all these orders come in at 68, 68, 75, and we had 79 orders come in right there, and we just weren't able to get higher. And then boom, we did. We popped up one more tick, and then we started staying there again. So I took the picture at 43. So it's got built-in order flow tools right in their time and sales. That is kind of subtle. And if you didn't filter it and you had it running at 0, it's going to move too fast for you to even really see that. But I run tape at filter. So I keep one at 0. I usually keep one somewhere between 8 and 10. And then I've got a bigger order that I keep that really only moves if we get big blocks and sweeps. That way, the one that's moving right here, I don't even try to read this one because reading it isn't my goal. I want to see how fast is it moving and what color is it? Because out of the corner of your eye, without even staring at it, if I'm looking at my candles over here, I can see that out of the corner of my eye and I can see those colors. I can see that movement. When we sell off really aggressive, the tape speed will pick up. This thing will flash really fast. And I want to see it black with that red depth behind it. If we're running to the upside and it's really fast, we're just like breakout and ripping, kind of like we were back here. I want to see the same thing in the other direction. Fast, fast tape, black with that green depth behind it. On the slower one that I set between 8 and 12, as long as it moves, say, within 10 to 12 seconds, that it doesn't just stop and not move at all, then I'm good. You have to adjust that through the day because obviously at the open, we're going to get so many trades that you'll have to turn it up. And usually it's like 18 to 25. But as the morning goes on, say 30 or 40 minutes, then you have to start moving it down. And I watch to see if it has moved yet. If I set it somewhere, say at 15, and it doesn't move within say a minute, I went too high. I need to bump it down a little. And then I set it there, wait to see if it moves. If it doesn't move within a minute, then I move it a little lower. So if you're going to apply a filter, you have to be willing to readjust it through the day if it starts moving too fast that you can't read it, or if it doesn't move at all and you're like, this thing needs to update, and turn the number down. Then the big one, rather than trying to spot when we get big orders, like bigger than 25 or bigger than 30, you can set your last filter for a high number. And that way, if they do jump in with both feet and start slamming it higher or lower, those big orders stand out. You don't have to sit there trying to find them, scrolling back looking for them. You'll just see them because you've got your big filter. So that's one thing that Tradeovate has in their order flow toolbox. Another thing that they've got is pulling and stacking. So you add that pulling and stacking, and now you can see that there's 2 asks. Well, this is really moving too fast. It's on the NASDAQ. So let's go to the ES. Yeah, that's slower. It will work better if we were on something like crude or maybe gold. Gold's moving kind of fast today, so maybe not gold, but on a slower day, gold would be good. It's meant for thicker markets, something that isn't moving so fast. but it's where you can see them adding orders to the queue and then taking them back off before they get filled. And that's called pulling and stacking. They're stacking orders on, taking them off, stacking them on, taking them off, pulling and stacking. But this, it moves too fast, so it's not helpful. Yeah, it can, not this particular platform, but order flow tools, absolutely, they work on equities. Yeah. Thinkorswim has Jigsaw, not Jigsaw, has Bookmap built into it. At some point, they took mine off, apparently. I'm gonna, no, there it is, right under my nose. You have to ask them to get that, and it's not free. You have to pay for it. But even just to have it showing, you got to reach out to support and say, "Hey, I'd like to have Bookmap." They'll push a button and then they'll tell you to restart your Thinkorswim, and when you turn it back on, you'll have the Bookmap there. But then, if you want to use more than just the free version, then you have to buy Bookmap. Um, no, I mean, so the I don't know if you can trade them there, but you can chart them there. I don't do it, but I remember at some point they asked me if I wanted equity data on this platform, which tells me, I could have had equity data. And to be fair, if I want to look at Apple or Google or something right this moment, I can, but it won't be um, live data. I bet it will be delayed if I try it. Boy, there it is. But they are a futures broker, so I don't think they would want the business of equity. That seems delayed to me. See how it's got the D behind it and it's orange? Data is delayed. Yeah. So a lot of people that have TradeAvate accounts, they just trade at TradingView. That's the prevailing thing to do because they don't like this. And I get it. TradeAvate's not overly friendly, but you get used to it, you know. And I've spent a lot of time getting used to it, which is why I don't want to go to funded futures network. This morning in the morning briefing, I mentioned that the ES and the NASDAQ were quite a bit apart. And I said at some point today, it was likely that one or the other was going to play catch up because one was mispriced. So if you want Thinkorswim to have order flow tools, turn your bookmap on. They've got Palantir and Tesla today. You never know what you're going to get when it's free because that's what I have is the free one. $40 a month for the bookmap version. It's a little bit of a tell when the ES and the NASDAQ are not running close together. But to spot it, you want to look at percentages, right? Because their prices are obviously far apart. The ES is up 0.2 and the NASDAQ is up 0.9. That's really close together compared to where they were this morning. This morning, I think the NASDAQ was at like 1.6 and the ES was at 1.1 or something. Like they were far apart. They're not far apart now. Getting a lot of options alert coming in. Of course, it's getting to the end of the day, so they're probably just clearing out. I know nobody wants to hear it in this context, but if you're trying to day trade equities right now, probably having a pretty hard time of it, or short term swing trade in equities right now, probably having a pretty hard time of it. We're in a transition period. It's not a good time to be getting short term swings and day trades in equities. But nobody wants to hear that because we didn't learn to trade just to sit out and not trade, right? I get it completely. I understand. It's just this is a really bad time to be trying to take those kind of trades because of the transition period. And to attempt to do it in this backdrop, it invites losses of a higher magnitude than you normally would get. So in normal times, when we have a consistent Fed message, right? When the Fed likes to do this forward guidance, and when they do that, we know they're going to cut or they're not going to cut for like the next three, four, five, 6 meetings. That structure is a gift. And when they do it, it's fantastic because we know exactly what the Fed is going to do. When we're in a different environment and they say, we're going to have to be data dependent, maybe we're going to cut, maybe we're not, we'll wait and see. I mean, they're certainly not raising rates, so we don't have that threat. But whether we get a cut or we don't get a cut, they put us on this hurry up and wait, we'll let you know. And the markets don't like that. And then you get what we have right now. This sell off that we've been seeing is because they're unwinding a rate cut that was priced into the market. We're not going down because of the AI and whatever the BS headlines have been saying all over the place. The market's unwinding a rate cut that was priced in. So, in the current backdrop, with a market like we have right now, that does not have a forward guidance Fed, but instead is a data dependent Fed who says every meeting we'll let you know what we're going to do at the next meeting when we get there. That sucks and it makes trading really hard and it wrecks our short term trades and it wrecks our intraday trades where we get these big midday reversals and V bottoms and flips. And don't get me wrong, I love to day trade. So a day trade is a day trade is a day trade. But you're better off using SPY or the Qs or IWM to day trade and dabble a little bit into equities if you get a really good day trade in equities. But I wouldn't struggle for equities in a day trade. Certainly no short-term swing trades unless it's like Captain Obvious moment, right? You're better off preserving capital, studying and hunting for when is it going to end and or what needs to end. Like I just gave you the answer, you know it's the Fed issue. But what if you didn't know? Then you'd want to spend this time trying to figure that out, not spend this time to find another trade. Because this is a really bad time to take short-term trades. Oh yeah, I mean, some days are a gift in beauty. They're just textbook, they're perfect and they're awesome. And then other days, it's like somebody just peed in the Cheerios and there's nothing good about any of it and might as well walk away. So the Fed issue is one thing and it's really easy to monitor, right? Catch a couple of headlines out there or, ask questions about what's the Fed's current regime. Are they providing forward guidance or are we data dependent and making the decision as we go? So that one is one thing all by itself. Then there's a whole other problem going on, right? We got the tariff issue and they're playing that to the hilt, right? They got their little shenanigans that they do, throwing a tariff on somebody, hyping it up, making it sound really bad. And then they back away and say, "Oh no, never mind. You know what? We're going to make an agreement." And it's just rug pulls and fakes and then it runs and pops and just keeps on going. So that's in a completely different regime. Then there's the never before seen AI bubble. I'm going to say bubble, but I don't think bubble fits there. But it's this, feeding frenzy where they're plumping each other up and it just keeps going up and up and up and up and they're pulling forward their earnings and it's a very unusual time. If the market doesn't know what to do with it, what's a new person supposed to do with it? Right? Like we're seeing funds and firms blow up because they don't even know what's going on. And if they can't get it, retail has no chance in getting it. So, in that backdrop, I'm not saying don't trade at all because that's not a good answer. But I am saying be very cautious about adding new trades. Keep the size down. No reason to trade with your regular size. Trade smaller, be willing to take profit sooner, and maybe just don't trade as much. I've dialed back a lot of my trades. I was counting them up the other day. I'm less than 300 trades right now. That's unusual for me. And the ones that I am carrying, a lot of them, they're locked to where they can't lose. So I don't have any reason to close them. Like whatever. If it can't lose me money, why why would I close it? I'll keep it on and see if it'll give me more. There was a good book that I shared a while back, and it's an old book, but it was written by Gerald Appel. He's the guy that is attributed for creating the MACD. Okay. So anybody you've used the MACD before, it's that guy. And what he did, he wrote a book about technical analysis and he gave these instructions. He talked about the Fed put and whether the Fed is in a hiking regime or not. But he also gave some moving averages and said that you can combine those moving averages on SPY and the Q in combination with what the Fed is doing. And then he talked a little bit about bonds and yields and said that if you put those four or five pieces together, that you can stay on the right side of the market in your bigger picture accounts, right? It was a good read. I mean, it was an older book, and some of the tools that he talks about building, we don't have to do because they're pretty much they're just out there now. But when he wrote the book, it would have been a lot of work back in those days to get it done. I'm looking for it right now so I can put it in the chat. I've done it before, but I don't want to have you guys scrolling back through 3 months of posts trying to find the darn thing. There it is. All right, so this book, it was a really good read, but it is an older book. It'll give you these 5 or 6 things to keep your eye on, and they're simple things, right? Like dollar, bond yields, the Fed, and the SPY and the Qs with a couple of moving averages. Well, that's pretty simple stuff, you know. And then when we're in these transition periods where we're all like, "Oh hell, I have no idea what's going to happen next." Well, okay, then why put money on it? Like Apple. I love Apple right now. It looks so good, but that's a double top breakout 111, right? Like it's textbook failure setup right there. Do I know it's going to fail? No, but it sure looks like my inside day breakout yesterday's 111 setup for darn sure. I mean, look at it. We failed at 111, stalled, failed again. We're just not getting into that 1, 2, 3, 6. And if it doesn't get up there soon, then I mean, what do we do? We're going to go back to the 100 and then, maybe the 786. So I don't know. It's there's a lot of red flags, and with the market now unwinding a rate cut, we're going to need a macro shock to fix things. And I don't know how much damage the macro shock is going to do before the Fed comes in and plays save a hoe. Yeah, I'm good. How you doing? Oh, well, I mean the good thing is we spent most of today talking about the 111 and the 1, 2, 3, 6, and my 5 minute answer won't do it any justice now. But it's all recorded. The main thing about the 111, the way that I use it is if a market's breakout is going to fail, it very likely will fail at a 111. So I want to measure a range, whatever that range happens to be. And if I'm expecting failure, then I will expect it to fail at that 111. If it doesn't, it might make it to 1, 2, 3, 6 and then fail. But most of the time, breakouts fail at the 111. If the failure occurs, then we expect it to come back to one and maybe even all the way back to a 786. And then we evaluate how price responded at that 786. Oh yeah, the way that you definitely want to watch the replay because I showed in the replay exactly how to track a market that keeps going. And it gives you the next leg up, the next stopping point, the next digestion period, and then from there the next leg up, the next stopping point, the next digestion period, all the way up. And as if it keeps on running, you got levels all the way up.